The real estate market is about to crash in 2024. All financial indicators are pointing to it. But why 2024? Well, keep watching to find out. It's been more than 20 years since 30-year mortgage interest rates were as high as they've been this month. The 30-year mortgage interest rate is already at the level where the price came down significantly. An excessive mortgage interest rate, plus economic recession, and boom, we have a real estate crisis in our hands. Similarly, the data on U.S. housing affordability is already at historic high levels. From the chart, we're already below the 2008 levels, where a lot of homeowners defaulted on their mortgages and were foreclosed. The current market hike in mortgages since 2020 might be a trigger to a housing crash. Increased mortgage rates and steep home price growth have reduced affordability. So, if mortgage rates continue to go up, while affordability remains low or continues to decline, boom, a crash is imminent. This time is more devastating because the value of houses has increased significantly compared to 15 years ago. Look at this chart. We are already at the 2008 levels of housing rates, and that's child's play to what's coming in 2024. The United States housing market is in its sixth major downturn since the late 1960s. In 75% of big cities, home prices have fallen monthly for 6 to 7 months. This presentation will highlight the locations where property prices have fallen the greatest and those that have been steady. We'll also compare the present downturn's depth. The most accurate home price index, the Case-Shiller Home Price Index, shows a national decrease that began in summer 2022. Traditional housing prices don't fall nominally. I'll discuss real or inflation-adjusted home prices later in the video, which is better for contextualizing home prices throughout time. Home values have dropped only 3 times in the last 30 years, according to the graphic. A 2% reduction occurred in the 1990 recession, whereas nearly a 30% drop occurred in 2008. Strangely, property values did not fall throughout the 2001 recession. National housing values are down about 3% from their summer 2022 peak. Recognizing geographical differences in real estate, some places have seen more than a 3% fall, while others are at their peak. We'll measure the home price fall and the correction's duration. Home values took 37 months to peak after a 2% drop in the 1990 recession. While housing values did not fall during the 2000 recession, they fell 30% during the 2008 recession and took 116 months to recover. Traditionally, the stage is set for a real estate downturn when there's a swift surge in residential property values, an uptick in the desire for housing, and a flurry of home flipping activities. Up until very recently, the real estate sector reveled in historically low interest rates, rendering homeownership more accessible. Yet, this frenzy of affordability has unleashed a storm of soaring property values. The unmistakable reality is that the appetite for housing is sprinting ahead of the available supply. What do you expect? What are the indicators for a financial crash in 2024? First, housing prices have gotten higher. Presently, housing affordability in the US has hit a 4-decade low, with 30-year mortgage rates creeping towards 8%. Even when adjusted for inflation, housing prices have soared well beyond the levels seen in 2008. The truth of the matter is that nearly every market in the US is grappling with overpriced properties. Interest rates have reached unprecedented heights, making affordability a daunting challenge, particularly for low-income earners. However, the mere fact that housing prices now surpass those of 2008 doesn't guarantee a bubble burst. The current market landscape presents a fresh set of obstacles and markedly different challenges compared to those leading up to the Great Recession. While it's not accurate to claim that this time is different, given the evident surge in housing prices, the underlying fundamentals have indeed evolved. The lending practices that fueled the 2008 crisis have mostly faded, and new factors now influence the market, adding layers of complexity to the current situation. Understanding these changes is crucial for anticipating the nature of any forthcoming correction. Let's delve into the distinctions between the housing landscape in 2008 and the present day. The 2008 housing bubble in the US was essentially a speculative frenzy, where houses were traded akin to stocks. It wasn't just trading, it was full-fledged day trading, where the anticipation was that of a short span, be it 1, 3, or 6 months. The property's value would skyrocket. However, this scenario unraveled when the housing market eventually collapsed. Fast forward to the prospective 2024 housing market bubble, if you will, and it's rooted in markedly different issues. While there's an element of speculation driving it, it's no longer solely investor-fueled day trading. The surge in prices stems from a significant shift in household formation, coupled with a considerable number of mortgages, still locked in at exceptionally low interest rates for the next 25 years, provided the holders retain them. The latter period witnessed a substantial increase in household formation, contributing to the prevailing supply shortage in real estate markets across North America. According to the National Association of Realtors, we currently face a shortfall of 6.5 million homes, a gap that would necessitate tripling housing starts, a scenario unlikely to unfold anytime soon, given the economic climate. The surge in household formation is unprecedented, driven by multiple generations vying for housing. The unexpected competition between baby boomers, millennials, and Generation Z for the same housing stock has increased the demand. The pandemic further accelerated home purchases, with younger individuals entering the housing market sooner than anticipated due to historically low interest rates and rising housing prices. This surge resulted in an unprecedented 17 to 18% increase in prices, fueled by heightened competition for limited available homes. Now, those fortunate enough to secure homes amidst this surge are sitting in properties acquired at yesterday's affordability levels. As a result, the likelihood of these homeowners putting their houses on the market remains low, contributing to the sustained scarcity of supply for new buyers. The entire scenario hinges on one crucial factor: the unemployment rate. Should the unemployment rate remain low, housing prices are likely to maintain their upward trajectory. However, if a recession unfolds, accompanied by substantial job losses and a spike in the unemployment rate, that could be the tipping point for the real estate market, triggering a downturn. The lingering question is whether this downturn would mirror the severity witnessed in 2008. And the truth is, nobody possesses a crystal ball capable of predicting the future. In all likelihood, a combination of these factors will shape the future. A modest decline in housing prices, a slight reduction in interest rates, coupled with wage growth, may collectively create a scenario where the real estate market readjusts to a more balanced state. However, it's crucial to acknowledge that a catastrophic collapse remains a possibility if any one of these factors experiences a significant and unexpected shift. The uncertainty underscores the importance of considering various elements at play in the dynamic realm of the real estate market. Secondly, economic downturns or sluggish activity often result in diminished disposable income, a reduction in job opportunities, and increased unemployment. In such a scenario, the demand for housing dwindles as people find themselves unable to afford homes. The equilibrium is disrupted, and the rapid ascent of home prices grinds to a halt. Stagnating house prices lead to those reliant on them for their homes facing the risk of losing their residences, further flooding the market with additional supply. How does this happen? Initially, the surge in interest rates renders homeownership unattainable for some. Simultaneously, the prevalence of adjustable-rate mortgages contributes to defaulting and foreclosures among homeowners. The rising interest rate acts as a catalyst, creating a devastating effect on the housing market. It's worth noting that a gradual increase in interest rates might not inflict severe damage on the housing market, unlike rapid ascent. Drawing parallels to the prelude to the 2006 housing market crash, many individuals were tied to interest-only and adjustable-rate mortgages, initially offering affordability, but later resetting to higher monthly payments. In recent times, the Federal Reserve aggressively increased interest rates in 2022 and 2023 to curb inflation and cool a surging economy post the 2020 coronavirus recession. This period witnessed a robust recovery, including a booming housing market with high record prices and scant inventory. Despite these efforts, signs of a cooling housing market emerged, marked by a sharp drop in home sales and a de-acceleration in national appreciation. The delicate balance between interest rates, market dynamics, and economic conditions continues to shape the intricate dance of the real estate landscape. The 2008 market crisis was the sharp decline in economic activity that started in 2007 and lasted several years, spilling into global economies, officially beginning from December 2007 to June 2009, and the ensuing global recession in 2009. We can expect the real estate market crash to happen from January next year or before the ending of the first quarter. If there's a new development, trust that you'll be the first to find out on this channel. So don't forget to subscribe so that you won't miss out on anything. Feel free to drop your comments below, share your thoughts, and let us know what topics you'd like us to explore next. Thanks for watching.